Hi, good evening, everyone. Today we have a new speaker with us. Mansi Kariya works with us in the fixed income team. Debt was recently in the news with all the taxation changes. So she'll be talking on various opportunities which are available on the fixed income side today. Over to you, Mansi.
Thanks, Raj. Good evening, everyone. I am Mansi Kariya, and I shall cover you all through various aspects of investing in debt. In the era of equity investments yielding 14-15% CAGR over a moderate period of 5 years, each one question comes to everyone's mind: why debt? We shall cover this in the slides to come. Risk is inherent in every aspect of life. Higher the risk, higher the return. But bringing stability is equally important. Debt brings that stability to your portfolio basis the risk appetite you have. Debt is a form of predictable regular income. It provides stable returns. Moreover, it also diversifies the risk of your portfolio. As you can see, monthly returns of equity and debt provides much stable and less volatile return for its investors. Equity is a volatile asset class and is best suited for long-term goals. For your short-term, medium-term goals or emergency requirements, debt investments are preferred. Another dilemma faced by the investors is how much in debt. A very common belief is 100 minus age for equity and rest in debt. But there are also other factors. Investors with safe business income, such as government employees or professors, can allocate more of their financial portfolio in equities. But a person with the income that is directly linked to equity market or even cyclical business should allocate more of their investment portfolio in debt. Risk appetite of the individual investors, cash flow requirements, investment goals also play a very important role. All the factors discussed should work together. Nothing should work in isolation. As you can see, 60-40 allocation has given cushion during downturns and also participated in higher returns. Historically, last 10 years, 100% equity has delivered 13.84% return with 30.74% standard deviation, while 60% equity and 40% debt allocation has given 11% return with 18.94% standard deviation. Before going into options for debt investment, let us discuss some significant risk. Credit risk. Credit risk is the borrower's ability to repay the principal or interest on time. Your principal protection is very important. Now, interest rate risk. Changes in interest rates affects many investments, such as equity, real estate, etc. But it directly affects the value of fixed income and other bonds and other fixed income instruments against indirect effect on other. Take a bond for example. A bond is a fixed income investment and bond prices and yield move in opposite directions. If interest rate rises, bond prices fall and vice versa. However, interest rate risk matters if your investment horizon is less than the maturity of the investments, especially if your duration is short and you have invested a bonds of a longer maturity. Duration risk. Duration is the magnitude of interest rate risk of a fixed income security. Higher the duration of a security, higher the impact felt on the change in prices on interest rates. A 7-year duration security will place a greater impact on the prices of its instruments than a 1-year duration security. Liquidity risk. Liquidity risk. means the difficult to liquidate investments when desired, or it has to be sold below its fair value. Options in debt investments include government small savings scheme, bank fixed deposits issued by NBFCs, HFCs, debt mutual funds, RBI direct lending scheme, direct investment in listed bonds. I will start with small saving schemes. Small saving schemes are a set of saving instruments which are managed by the central government in order to encourage citizens to save irrespective of their age. Some of this security will offer tax deduction under Section 80C, while others do not. Interest income is taxable in all the schemes except PPF and Sukanya Samriddhi Yojana. Interest rate of savings schemes does not move at par with repo rates and are thus sticky. My yellow line is the RBI repo rate and the other three are NSC rates, PPF and Sukanya Samriddhi Yojana and senior citizen saving schemes. As you can see, the small saving interest rates are sticky. Accordingly, at different points of time, these are favorable or not. No one can deny that small saving schemes are the safest form of debt instrument. Also, there is less volatility in yields. But there is no liquidity available, though one can take loan against certificates. There is a limit for individual investors to invest in these schemes, such as 30 lakh for senior citizen savings scheme and 1.5 lakh per annum for PPF and Sukanya Samriddhi Yojana, etc. One needs to look for other debt investments after opting for these schemes. Now, bank fixed deposit. It is the most preferred long-term investment vehicle in India. One can get fixed return by investing in a maturity with ranges from 7 days to 10 years. Also, there are special rates for senior citizens. Interest income is taxable as per your tax slab. Instruments can be redeemed with a penalty, with ranges from 0.5% to 1%. Security in the form of insurance cover is available only up to Rs 5 lakh deposit with each bank. Company fixed deposits. These are term deposits offered by NBFCs and HFCs and other corporates. These are usually offered at a higher interest rate than bank fixed deposit. Also, premature penalty is higher. Interest income is taxed as per your tax slab. There has been history of companies defaulting in company fixed deposits. FDs available at an attractive interest rate carry risk associated with it. Don't invest in company FDs unless you are sure about the company's credentials. These are the FD rates of top public sector banks, private banks, HFCs and NBFCs. Now coming to debt mutual funds. A debt mutual fund is a mutual fund scheme which invests in various fixed income instruments. Since it invests in various instruments, you will get diversification benefit in the form of various securities and funds. Also, there are multiple options based on your investment horizon and risk appetite. All the funds are mostly open-ended, so there is a high liquidity. Also, there is a partial withdrawal available. You can withdraw 5,000 with your deposit of 1 lakh and you can the rest 95,000 keeps growing. Debt funds have a potential to offer capital appreciation over a period of time. There is no defined time horizon. Sometimes you don't know the exact period when you require money. So, the debt mutual funds offer this liquidity. There has been amendment in the tax structure of debt mutual funds last month. The finance minister on 24th March 23 announced an amendment to the budget 23 in the capital gain tax of debt funds. Mutual funds holding less than 35% of equity hold under this category. Before 31st March 23, gains from mutual funds holding less than 3 years are treated as short-term capital gain and are taxed as per your tax slab. But over the mutual funds, gains from mutual funds held for more than 3 years are treated as long-term capital gains and are taxed at the rate 20% with indexation benefit. According to the amendment, gains from debt mutual funds which have invested on or after 1st April 2023 are treated as short-term capital gain and are taxed as per your tax slab. Old investments continue to receive indexation benefit. This created dilemma among investors that now debt mutual funds are at par with bank FDs and it is beneficial to invest the same or not. We will discuss. Taxation. Income from debt mutual funds are taxed only when investments are redeemed. Against bank FD, where you will be taxed every year on interest income on accrual basis, also subject to TDS. Income from debt funds are classified as capital gains and not interest income, unlike bank FDs. And this can be set off against other capital losses. Suppose in a bank FD, if you are getting 8% interest and if you have invested 10 lakh, for the first year, your interest income will be 80,000. Assuming 30% tax bracket, your taxation will be 30% of 80,000, that is 24,000. Now, if you have invested 10 lakh in debt mutual funds at a NAV of 100, after 1 year, suppose your NAV is 108, your investments become 10 lakh 80,000. Now, if you withdraw the 80,000, you can withdraw the 740 units at the rate 108. For that, you will be taxed only on capital gains, that is rupees 8 for 740 units, that is rupees 5920. Your taxation will be 1776, that is 30% of 5920, as against 24,000 in case of bank FDs. Same thing you can claim in the second year. The taxation will be more than first year, but still it will be better than bank FDs. So you can defer your taxation. Let us discuss some important terms for debt mutual funds. Y2M. Y2M is the total rate of return an investor expects to earn if the bond he or she has held is held to maturity. So your Y2M of a debt fund is the weighted average Y2M of all the securities in a fund. But there are variations due to reinvestment. Average maturity. It is the weighted average maturity of all the securities in a debt fund. Macaulay duration. Macaulay duration calculates the weighted average time to receive debt cash flows from a debt security. The Macaulay duration of a debt fund is the weighted average duration of all the securities in a fund. It is the minimum time that is required to invest in a debt fund so that your interest rate risk is minimized. Modified duration. Modified duration calculates bond sensitivity to interest rates changes. So, a bond with longer maturity are more sensitive to interest rate changes. Expense ratio. As returns are comparatively low on debt funds, so expense ratio is a very critical consideration for debt funds. Now, where do mutual funds invest? Mutual fund invest in commercial paper, certificate of deposits, government securities, state development loans, corporate bonds, etc. Government security and state development loans carry sovereign guarantee, so there is no credit risk. Yes, but there is interest rate risk. Certificate of deposits are issued by a bank for a maximum maturity of 1 year. Since banks are regulated, this carry moderate credit risk and interest rate risk. Commercial papers issued by corporates and NBFCs for 1 year. This carry high credit risk and moderate interest rate risk. NCDs issued by public financial institutions and public sector undertakings are also government, so they carry low credit risk, yes, but high interest rate risk. NCDs issued by NBFCs and corporates carry substantial credit risk and interest rate risk. Tier 2 bonds issued by bank are complex instruments. Tier 1 bonds are riskier as these are perpetual bonds. Banks can hold interest in case of stress situation. So these are riskier than equity. Both these bonds carry high credit risk and interest rate risk. There are two categories of debt mutual funds, passive and active. Passive aim to replicate index, relatively low cost, have predefined maturity and better visibility of returns. As against, active mutual funds aim to outperform index, relatively high cost, possible higher returns, and there is no predefined maturity. These are the different categories of passive mutual fund. I will be covering target maturity funds since these are very popular among retail investors. Target maturity funds index fund. As per SEBI mandate, this invests in GSEC, SDL and PSU bonds. So there is low credit risk and high liquidity. They track an underlying bond index customized for the sale. So they have to invest in the same index proportion. They have defined maturity dates. They generally invest near to the maturity dates. Returns are in line with the YTM, so there is better visibility of returns. Also, these are relatively low cost as these are passively managed. One is exposed to high interest rate risk if withdraw funds before maturity. There are target maturity funds available for every maturity. So one can plan important goals matching maturity such as education, car, travel. Since there is better visibility of returns, one can plan goals and with specific maturity. Target maturity funds ETF are same as index funds regarding indexation, credit risk, liquidity, etc. This can be bought and sold in the exchange through Demat account and also FOF route through mutual fund. Expense ratio is half than index funds. These are rebalanced quarterly and disclose portfolio every day. So there is better transparency of returns. Now, active mutual funds. I will start with money market funds. Money market funds invest in T-bill, GSEC, SDL, CP, CDs, etc. Liquid fund invests in a securities which matured from 0 to 3 months. Ultra short duration fund between 3 to 6 months. Low duration funds 6 to 12 months. And money market funds can invest in any securities up to 12 months. This can be used as alternative to savings bank account. Here past returns don't help. You can consider YTM as your expected return. There is low interest rate risk due to low durations. Avoid investing in funds which invest in lower rated papers. One must consider safety over returns as these are your emergency requirements. This can also be helpful in STP in equity schemes, and there is no exit load after 7 days for most of the schemes. I have mapped the SBI savings rate interest and money market funds. Green line is my SBI savings bank interest, blue is my liquid fund, and the other two are low duration fund and ultra short term fund. During 2021, the spread between money market instruments and SBI savings bank is very low. So there was no benefit on shifting funds from savings bank account to money market funds at that time. But as RBI has increased repo rates, the spread has increased for as large as 300 bips. So one can benefit in case of shifting from savings bank to liquid funds. Also, ultra short duration fund and low duration fund yield more than liquid funds, but these are often volatile. Invest in these funds if your maturity horizon is 3 to 6 months, or else liquid fund is the best alternative to savings bank account. Duration-based funds. Duration-based funds invest in security such that the macular duration of the fund is within the category mandate. Short duration fund. Short duration fund invests in securities such that the macular duration of the fund is between 1 to 3 years. There is moderate sensitivity to interest rate changes due to low durations. Yes, but have credit risk. This offer higher yields than liquid funds and ultra short duration funds. Medium to long term duration funds are often risky and are more vulnerable to interest rate changes. Investment horizon less than macular duration of the fund can give negative returns. Fund with lower rated papers will give higher returns but are subject to credit risk. So invest in a fund which may give you lower return than the category but rules out the likelihood of a painful default. These are the historical return and return expectations of all the duration-based funds. As you can see, past returns and not even YTM gives us incentive to take interest rate risk in medium and long duration funds. This may change with interest rate expectations and credit spreads. Dynamic duration funds. Dynamic duration funds can invest in securities and shift duration according to interest rate expectations and market environment. It is very difficult to align your investment horizon with the duration of these funds, as this may change. So, minimum 3 to 4 years of investment horizon is required to invest in these funds. There are 5 categories. We will discuss each category in detail. Dynamic bond fund. Dynamic bond fund can invest in varying maturities and debt instruments depending upon the market environment. They, they can shift duration and credit profile based on market expectation of interest rate risk. There is a possible higher returns with increased risk. These funds carry fund manager risk and can give negative returns if market expectation goes wrong or there is mispricing of risk. Trust the philosophy of a fund manager before investing in these funds. I have mapped the duration and YTM of a median dynamic bond fund. As you can see, the fund manager has changes duration with from 7.5 to 2 with changing YTM according to market expectation of interest rates and credit spreads. The same fund has changed credit profile which ranges from 66% AAA in 2019 to 100% sovereign papers due to low credit spreads. Guild fund. Guild fund can invest in both central government and state government securities. Since these are guarantee of government, so this carries zero credit risk. Duration ranges from 1 to 10 years, so carry high interest rate risk. Manager change their duration with the market expectation of interest rates. Possible higher rate in case of decreasing rate environment and opposite in case of increasing rate environment. I have mapped the rolling returns of median gilt fund for the last 10 years. As you can see, the volatility of returns, which range from 2% to 14%. Minimum 4 to 6 years of investment horizon is required to invest in these funds as these are very volatile. Corporate bond fund. Corporate bond fund invest in bond issued by banks, PFIs and corporates. As per SEBI mandate, 80% of the portfolio needs to be invested in AA plus and above rated papers. Duration is generally 2 to 5 years, as corporates generally raise for that period. So, this carry less interest rate risk than gilt funds, but credit risk needs to be monitored. Credit worthiness of portfolio companies is important factor to be considered before investing. This carry liquidity risk, so diversified allocation of portfolio is very important. I have mapped the 3 rolling returns of corporate bond fund, gilt fund and dynamic bond fund. Since RBI raised repo rates and the credit spreads are low, credit gilt funds has done better than corporate bond funds and dynamic bond fund. At this time, there is no benefit to take credit risk from corporate bond funds and dynamic bond fund. But if you see return pre-financial year 18, corporate bond funds has done better than the other two. Credit risk funds. Credit risk funds invests at least 65% in low quality debt instruments, that is AA minus or lower. The fund is suitable for high risk investors, generally managed at a high expense ratio, as fund manager specialization is very important for selecting companies. Carry liquidity risk in a market turbulence, as fund manager may not be able to sell securities to meet redemptions. Diversified portfolio is beneficial over concentrated portfolio because of exit risk. Three-year rolling returns of credit risk fund have fared 10% to 11% during 2016 to 19. But post DHFL and ILFS episodes, fund managers become very careful in selecting securities. So it has now reduced to 8%, which is near to corporate bond fund or gilt fund. So there is no incentive to take credit risk, makes this category unattractive at this time. This may change with change in credit spreads. Banking and PSU debt fund. Banking and PSU debt fund invests 80% of the portfolio in AAA bank and PSU bonds. No restriction in duration makes this category high vulnerable to interest rate risk. Banks are regulated and PSU bonds are government debt, make this category less prone to credit risk for 80% of the portfolio. Presence of bank Tier 1 bonds in the portfolio increases the volatility of the fund, as these are perpetual bonds and duration is calculated as 100% for these bonds. But now SEBI has mandated to invest it maximum 10% in this bond to protect investor interest. Floating rate fund. Floating rate fund invests at least 65% of the assets in floating rate instruments. They invest either in floating rate instruments or in fixed instrument which can be converted into floating by interest rate swaps. Since interest rates are reset on periodical basis, this carry low interest rate risk and duration risk. These are beneficial in an increasing rate environment. Liquid fund and ultra short duration fund invest in instruments maturing 3 to 6 months, allowing the funds to capture rising near-term yields better than floating rate funds. Conservative hybrid fund. Hybrid fund invests in a mixture of equity and debt instruments. Since I am covering debt, I will cover conservative hybrid fund. The fund has a mandate to invest 75% to 90% in debt instruments and rest in equity and REITs. Small exposure to equity allows the fund to potential to earn better return than pure debt schemes. Also, one can get diversification through a single investment rather than through multiple options. Taxation is similar to other debt funds. Just like dynamic debt fund, this can invest in any maturities and securities as per the maturity available, and also equity component can invest in any capitalization stocks. These are suitable for medium to long-term horizon. I have mapped the two funds. These are two conservative hybrid funds. Fund 1 has a YTM of 7.91% and duration of 2.87. Fund 2 has Y2M of 8.29% and duration 1.17. Both these funds carry same capitalization stocks approximately. While the Fund 1 invests 50% in government securities and 1.1% in lower rated papers, that is AA and below. While Fund 2 invests only 17.36% in government securities and 20.78% in AA and below securities. Both these funds carry almost approximately near equal amount of cash. Interestingly, Fund 1 has an expense ratio of 0.44%. So your expected return you can tell is 7.5%. While the expense ratio of Fund 2 is 0.99%. So your expected return will be near to 7.3%. So you can see you can expect more return with 50% sovereign papers. So portfolio composition is very important to invest in conservative hybrid funds or any funds. How to choose a debt fund? A debt fund key is the YTM, not the past returns. A debt return is the past return, while the FD return is what you will expect in the future. Comparing past return with future returns is not a prudent approach. While higher YTMs may seem attractive, carry high credit risk associated with it. If the Y2M of a debt fund is significantly higher than the peers of the same category or duration profile, check the credit profile of the underlying securities in the portfolio so that you can take informed investment decisions. A well-diversified portfolio mitigates the concentration and liquidity risk. Expense ratio of a debt fund gives you a ballpark idea of the future returns of the scheme. Higher expense ratio will hurt returns, as you have seen in the previous slide. Ensure duration of your debt fund matches with your investment horizon, other than dynamic debt fund, where 3 to 4 years of investment horizon is preferred. Now we will discuss RBI Direct Lending Scheme. Under this scheme, retail investors can open direct gilt account with RBI. Retail investor can buy treasury bills, GSEC and SDL through online account. Minimum amount required is 10,000. Investors face high interest rate risk if they require fund before maturity, and also liquidity risk as these are not so active for retail investors. Yeah, but you get sovereign guarantee if you want to hold the funds till maturity. Interest income is taxable as per your tax slab, and long-term capital gain, which is 12 months in this category, will be taxed at the rate 10% without indexation benefit. Direct investment in listed bonds. It facilitates direct investment in bonds issued by BFI and corporates, and also tax-free bonds. It allows investment through demat account. Interest in taxable is as per your tax slab, and also long-term gain like RBI Direct Lending Scheme is taxed at the rate 10% without indexation benefit. The major drawback is low liquidity. You may not be able to sell securities at a fair value before maturity. Also, the single tick size may range from 1,000 rupees to 1 lakh. It is now become 1 lakh. So, you will also face, there is no diversification benefit. Also, the investors face concentrated risk as they have exposure in a single bond as against mutual fund schemes where you can get diversification benefit with as small investment as 5,000. And the most important, this carry credit risk. So you have to monitor, you have to understand the company in which you are investing. Now I will brief about current market scenario. Across the globe, central banks raised change repo rates in response to inflation and growth. This keeps inflation and growth under check. The immediate impact of change in repo rates is reflected in market interest rates. In order to ease economic hardship and also to help investors keep inflation under check, RBI slashed the repo rates to as low as 4% during COVID-19. It continued till March 22. Only after when the interest inflation goes above 6% for 3 consecutive months post Russia Ukraine crisis, RBI started increased interest rates in a phased manner. It has increased interest rate up to 50 bips up to 6.5%. As per current month inflation, it is 5.6%, which is now within the RBI target rate of 2% to 6%. Also, as per current RBI policy, they took pause and keeps the policy rate unchanged. As of April 21, yield curve was moderately steep. But due to increase in repo rates, yield curve flattened with short-term rates increase at 280 bips and long-term rates at 120 bips. Also, my blue line is AAA spread and orange line is AA spread. AAA spreads were 50 to 60 bips pre-financial year 18. After DHFL and ILFS episodes, it increased to 110 bips. But after that, there was a conservatism was at its peak, and which increased the demand of AAA rated papers. This created a clear mismatch between demand and supply of papers as there is more demand against the supply, which slashed the AAA spreads to as low as 5%, which is now 5 bips, which is now 30 bips and remains unattractive. AA spreads move in tandem with AAA spread, but AAA spread almost vanished. Also during April 21, yield curve was moderately steep and AAA PSU bonds are even yielding less than state development loans. My green line is PSU bonds and red is SDL bonds. They are even yielding less than state development loans due to the reasons discussed in the previous slide. But now yield curve has flattened and now short-term PSUs are yielding better than SDLs. Active fund can take the advantage of yield curve positioning and credit spreads according to the change in market environment. Passive funds cannot take this advantage and are best suitable for important goals with better visibility of returns. Liquid funds and other money market funds are best suited for your emergency requirements and are used as your alternative to savings bank account. For important financial goals with predefined maturity, target maturity funds serve the purpose with high liquidity and low credit spreads. To earn risk adjusted return, dynamic duration funds and conservative hybrid fund serve the purpose with minimum 3 to 4 years of investment horizon. Thank you. Good. Any questions?
Yeah, hi. Thanks for the presentation. So typically people park their emergency funds in say liquid funds or the other money market funds as you mentioned. What is your view on arbitrage funds, versus these funds as an avenue to park your surplus savings?
Yeah, arbitrage funds is also good, but there is better predictability of returns in case of liquid funds. You have, as you can map YTM for this.
But is that not offset by the higher taxation in debt because arbitrage is considered as equity taxation, right? Which is 15% worth.
Yeah, if this your emergency requirements before, if there is, you can we'll be investing for less than 3 years now, as before this indexation changes now.
But I was just checking, I think on a rolling 3 or 6 month period, I don't think arbitrage funds have given negative returns. So just wanted to get your view that, do you think arbitrage funds can be considered as a safe alternative to liquid or money market funds?
Yeah, I think for high tax bracket people, uh, there is a 15% benefit in terms of taxation. So, arbitrage fund will be at 15% short term capital gains equity taxation, and liquid fund will be anywhere with surcharges anywhere 20, 30, 40 kind of thing. Especially after this recent tax change, uh, the attractiveness for fresh investments in the arbitrage category goes up dramatically. However, the issue that I see going forward is that there is a limited capacity that arbitrage fund can absorb because everyone will try to buy in the cash market and sell the futures. In the future markets, apart from the arbitrage players, there are also short sellers. So while taxation benefit will remain, uh, 15% versus up to 39-40%, definitely there's a advantage. But the absolute returns, I would suspect, would come down quite sharply with inflows coming in.
S- So do you think that equity savings fund could then be, an alternative as against arbitrage funds? I mean, would they have a naked exposure to equities of what, about 20%?
So the entire ecosystem is in a shock, given that the entire debt taxation, which earlier was, let's say, 7% is the return and 5% is the inflation, and you get pay 20% tax on 2%, which is the real rate of return. Moving from that regime to a regime where the entire 7% will be taxed at up to 40%. There's a big shock. Now, however you slice it and dice it, uh, equity savings fund or whatever, somewhere, some component of that will come to arbitrage. Uh, that arbitrage portion, I think there will be lowering of returns in that segment. For people with clear, defined allocations of equity versus debt, let's say if you want a 65 equity allocation and 35 debt allocation, earlier typical recommendation would be choose a equity fund and choose a debt fund. Now I think hybrid funds will increase in attractiveness given that uh, managing equity plus debt in the single scheme will be more of a tax advantage. Again, how long this arbitrage remains to be seen, because next year most likely it will be a vote on account. It won't be a regular budget because of the elections. But after elections, there is every possibility that these tax arbitrages could also be uh, attacked, or there would be some uh, even treatment of various asset classes. So it may at best be a 1.5 year solution. Right now, arbitrage looks good, with the caveat that the past returns that you see may not sustain in the future. So while tax advantage would be there, absolute returns could come down very, very sharply in the coming months. Secondly, if you are clear that you want some debt exposure and some equity exposure, doing it via hybrid funds is now more beneficial versus allocating to pure equity funds and pure debt funds.
And the typical equity allocation, naked equity allocation in an equity savings fund would be what, about 10-15% or higher?
1/3.
One. Okay, and just one last question. Given that both conservative debt funds have also returned about 8.5-9% over the last 10 years, don't you think that is a better alternative versus investing in a long duration fund and taking, an interest risk, credit risk, duration risk, everything?
Yes, it is better. And there is also less volatility.
Got it. Thank you.
Hi, thanks for this informative session. Given the current interest rate scenario that RBI has paused, and assuming that is one more high, and then we have a stagnant period, and then the interest rate starts falling. So currently we are at 6.5, we move to 7, and say again in 3 years period, we come to around 5, 5.5. How could an investor take advantage of capital appreciation along with the high yield to maturity that we currently see? So target maturity fund, what duration would be an ideal one if we are assuming this scenario, or your views on that?
Medium term duration funds, medium duration like 2028-29 are, according to me, are for the medium term horizon are attractive because yield curve is flat. So there was maybe no benefit for taking interest rate risk beyond that, because we don't know the scenario. If the interest rate started increasing, then this may give less returns than other funds.
Yeah, just one follow-up. So, assuming as a scenario, on say this 6.5 to 6.5% interest rate does not come till 4.5, but even if it comes till 5, it is roughly like 20-25% interest rate reduction. So, what is the kind of capital appreciation along with the current yield to maturity what we are seeing? So, could we look at say 20 odd percent of capital appreciation plus the current yield that we are getting if we are looking at a 4 to 5 year scenario?
But we don't know that if it will fall to 5%. If we took a pause and if we think of capital, we may get money. You will not be, there is no surety of if interest rate rise, then you may not get capital appreciation, because scenario, we don't know the scenario after 2 years. No?
Perfect. No, I understand that. So we cannot predict the perfect interest rate scenario. Just I was about to get a fair idea about say 20% interest rates goes down, then what would be the kind of capital appreciation along with the current yield that we get?
But see, if you can just go back in these slides to the yield curve across different time periods. Earlier. Yeah. So this shows April 21 versus April 23, right? What you are proposing is you expect interest rates to come down. So let's go and buy a 15-year bond, which is 2038 bond, and interest rates will fall sharply by 2 percentage points or 2.5 percentage points, and you'll make 20% capital gains over there. But the longer rates may not fall as much, even if shorter rates come down. So typically, you have upward sloping yield curve. Let us say from the April 23 yield curve, you go to April 21 yield curve, the longer dated yields may not fall so much. So there are a lot of assumptions built into it. It's like me saying if EPS of Nifty companies goes up by 2x in 3 years, should I buy equity? Answer is surely yes. But that is assuming Nifty EPS will double in 3 years. What you are saying is if long dated yields fall by 2 percentage points, definitely you should buy longest dated paper. If you should buy 30-year paper if you are so sure that interest rates are coming down. Yeah. So that is dependent on assumption, and further the assumption that longer yields will fall as much as the shorter yields, that is not correct, because typically when RBI starts cutting rates, shorter rates will come down, longer rates may still be sticky.
This scenario, based on individual assumptions, if that duration paper or a target maturity, say 5 years, 6 years is bought, then you may take the maximum advantage.
Yeah. So just like in equity, we say don't try to time things or don't try to make too many predictions. Typically, funds will have staggered maturity. They'll have 1 year maturity paper, 2 year, 3 year, so that they are not unduly locked into one particular security.
Yeah.
Hedge funds or speculators or people who are making predictions, if they are bullish, they will give margin and buy futures positions, or they will short sell. What you are advocating is taking a very strong view and going for a 6 rather than taking singles. In which case, buy the longest maturity. If you are confident rates are going to fall, simple answer is buy 30-year bonds.
But thanks.
Be as much as the decline in the interest rates, right?
It's a mathematical formula. You have ready-made bond calculators. You put in the coupon rate, current price, and maturity, and YTM. You change the YTM by 2 percentage points, you get the new price, down to the last decimal. Bonds are very mathematics driven, so there's no ambiguity over there.
Any questions on Zoom?
Hi, can you hear me?
Yeah, Kavan, go ahead.
Wonderful presentation. And my different one answer. My question is about this direct interesting in what's to RBI's new
Direct investment in bonds will be taxed. Interest income will be taxed as per your tax slab, and your capital gains more than 1 year will be taxed at the rate 10%. And against debt mutual funds, where everything is taxed at the rate, short-term capital gain is taxed as per your tax slab. And bank FDs, your interest income is also taxed as per your tax slab. Can arbitrage fund give negative?
Theoretically, yes, but practically very low probability. So when there is a extremely negative environment in the market, and if futures prices are trading at a discount to the spot prices, and because of asset allocation requirements, arbitrage funds keep doing long in spot market and short in futures at negative spreads, then for a few months that could be a scenario. In the past, I think in the COVID period, 1 month there was such a scenario, but practically it's a very low probability event.
It's long-term capital gains after 1 year, and it's taxed at 10%.
Yeah, but Kavan and everyone else who's excited by that, if you hold the bond to maturity, chances of making capital gains are close to zero. If you buy at par, on maturity, the bond will redeem at par. So unless you are able to time it so effectively, saying that you will enter at the right time, exit at the right time, and hold for an exact period of 12 months, you will not practically be able to benefit by this concessional tax rate on capital gains. The reason why debt funds were giving you capital gains is because they were not paying out the coupon that they were getting, and growth plans were growing the NAV instead of periodic payouts. That benefit is not available on these RBI direct government platforms. You will, on the coupon, you will end up paying the normal slab rate, so there's no advantage over there. And in fact, you can't even defer the taxation like in a debt fund.
Got it. Thank you.
Thank you very much.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes, but when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, but stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.